On February 26, the silver market did not just wobble, it cracked in public. The biggest paper venue on Earth went dark for roughly 90 minutes, and when it came back, the price was pushed lower as if nothing had happened. But something had happened. While New York was frozen, Shanghai was still trading, and physical silver there was changing hands near $104 an ounce, about $15 above the Western paper price for the exact same metal. Same commodity, same day. Two radically different prices. And that is not a normal market. That is a warning flare. What you are about to hear is not really about a glitch. It is about what the glitch exposed. Because systems do not fail randomly at the exact moment pressure is building. They fail where they are weakest. And on that day, the weakness showed up right where the world looks for the silver price. Before we go further, take 1 second and do 2 things. First, subscribe if you value deep analysis over noise. Second, tell me in the comments where you are watching from and one thing you trust more right now, paper claims or physical metal. Because this story is bigger than one afternoon. It reaches across every market that still pretends trust can replace delivery. The sequence matters, so let's slow it down for one moment. In the early afternoon, the electronic platform handling major silver futures stopped functioning properly. Screens froze, quotes stopped moving, order books went quiet. Traders could not update positions the way they normally would. Hedgers were trapped. Speculators were trapped. Liquidity providers were trapped. For roughly an hour and a half, the system the world treats like the heartbeat of silver price discovery simply stopped doing its job. And that alone would have been a major story. But it becomes a completely different story when you realize that physical trading elsewhere did not stop. Shanghai kept going. The world's most important paper market paused, while a major physical market continued to print a much higher number. That is where this turns from a technical inconvenience into a systemic question. Because in a healthy global market, a price gap like that should not sit there casually. It should get attacked immediately by arbitrage. Traders are supposed to buy the cheaper market, sell the more expensive market, and compress the spread fast. That is one of the basic promises of modern finance. That is one of the reasons people are told to trust the screens. The screens are supposed to reflect reality because money rushes in wherever reality and price separate. Except this time, the separation stood there like a wound. And then, trading resumed. And instead of the paper price racing upward to close the gap with the physical market, silver was shoved lower, fast, hard. Almost like the reopening was not a return to normal trading, but an opportunity to reassert control over the narrative. By the close, much of the earlier strength had been erased, momentum was broken, and the average viewer was left with the impression that the rally had failed on its own. That is the part that should bother you. Because if the market was merely offline for technical reasons, why did the return look like a coordinated pressure event? Why were some sectors restored faster than precious metals? Why was the physical market in Asia screaming one message, while the paper market in the West resumed with the opposite one? And why does every explanation stop at the words, technical issue, as if that phrase is enough to end the conversation? It is not enough. To understand why this matters, you have to understand what most people mistakenly think they own when they own silver. They think silver is silver. They think a contract referencing silver is just a convenient digital wrapper around the real thing. They think the paper and the metal are closely linked, almost interchangeable, separated only by logistics. That assumption is the foundation of trust in the paper market. But the foundation is much shakier than most people realize. When someone buys a silver futures contract, they are not buying a bar. They are buying a promise. A promise that under certain conditions, if held into the right window and processed the right way, can become a claim on physical metal. But the overwhelming majority of these contracts never make that journey. They are closed, rolled, or cash settled long before delivery becomes a live issue. That sounds harmless until you see the consequence. If almost nobody asks for metal, the system learns it does not need much metal. It only needs enough to satisfy the small minority who insist. That is how paper expansion begins. That is how 1 ounce becomes several claims. Not because someone sits in a room plotting it like a villain in a movie, but because the market structure quietly rewards that behavior year after year. As long as most people want exposure and not delivery, the paper supply can balloon far beyond the physical supply. And that is exactly what happened. So now you have 2 different worlds living under one name. You have the paper world, where silver can be created in contract form far faster than it can be mined. And you have the physical world, where every ounce must actually exist, be refined, be stored, and be moved. Most of the time, those two worlds overlap enough to preserve the illusion that they are one market. On February 26th, they did not. That is why Shanghai matters so much here, because Shanghai is not merely another exchange printing another opinion. It is a physical signal. It tells you what buyers are willing to pay when metal must actually change hands. It tells you what silver costs when delivery is not a theoretical option buried in legal language, but part of the structure itself. So when Shanghai is around $15 higher than the Western paper price, that gap is not just a spread. It is a statement. It is the physical market accusing the paper market of understating scarcity. Think about what that means in the real world. If you run a factory and need silver for actual production, you do not care what a frozen screen in New York says the price should be. You care what it costs to secure real metal that can arrive when you need it. If one venue offers a fantasy price attached to delayed or uncertain access, and another venue offers a higher price attached to real delivery, which one is the real price to you? The answer is obvious, and that is where this becomes dangerous for the paper system. Because paper systems are strongest when faith is automatic. They are strongest when almost everyone agrees to treat claims as good as goods. The moment participants begin preferring the thing over the claim, the multiplier becomes fragile. The moment enough people want bars instead of contracts, the structure stops looking efficient and starts looking under-collateralized. This is not some new problem. It is old, very old. Financial history is full of moments when markets function beautifully until too many people ask for the asset behind the promise. That is when tone changes. That is when rules change. That is when emergency powers suddenly appear. And precious metals have their own long record of these moments. Back in 1980, silver did not just rise, it exploded. Delivery pressure intensified. Large participants moved aggressively, and the exchange did what exchanges do when stress threatens the machinery. It changed the terms. Margin rules shifted, position limits tightened, access changed. The people who had played under one set of assumptions discovered that the assumptions themselves were reversible. That episode matters for one reason above all others. It proved that when physical pressure collides with institutional stability gets protected first. Then came nickel in 2022, where an exchange did something even more shocking. It did not merely pause, it canceled trades. Entire profits vanished with the stroke of an administrative decision. Why? Because allowing those trades to stand threatened powerful participants, and through them, the infrastructure itself. That was one of the clearest admissions modern finance has ever given us. Not in words, but in action. Price discovery is important right up until it becomes dangerous to the people running the venue. Then survival outranks purity. Carry that lesson back to silver. If the paper-silver market is many times larger than the immediately deliverable pool beneath it, what happens when the wrong kind of demand shows up? What happens when not 2% but 10% or 20% wants metal? What happens when industrial users, sovereign actors, or major funds stop treating futures as a game of exposure and start treating silver as something to be secured? You already know the answer. Trading halts, settlement changes, rule books get interpreted creatively. Force majeure language suddenly matters. Cash is offered where metal was expected, and the official explanation is always some polished version of the same sentence. These actions were necessary to maintain orderly markets. Orderly for whom? That is the question sitting underneath February 26, because this was not just about a halted platform, it was about what the halt revealed regarding control. The silver market is not an open field of thousands of equal players discovering truth in perfect competition. It is shaped by a relatively small cluster of large institutions that make markets, clear trades, manage inventories, warehouse risk, and often hold enormous derivative exposure at the same time. That concentration changes everything. When a handful of players sit at the center of price discovery, liquidity, and settlement, their incentives matter more than the slogans on finance textbooks. And their incentive is not abstract fairness. It is stability of the system they dominate. If that requires suppressing disorder, they suppress disorder. If that requires leaning on narrative, they lean on narrative. If that requires calling a rupture a mere connectivity issue, that is what the public hears. And here is the deeper layer almost nobody wants to say out loud. Low precious metal prices serve a political function. When gold and silver stay subdued, they reassure the public that monetary conditions are stable. They soften the visual evidence of currency debasement. They help preserve confidence in financial assets, in government debt, in the idea that inflation is manageable and trust is deserved. For decades, central banks and allied institutions have had every incentive to prefer calm, disciplined metals rather than metals screaming that something is wrong. You do not need a dramatic secret meeting to understand that. Incentives alone are enough. Now look again at what happened. A key Western platform goes dark during a period of strong upward momentum. Meanwhile, an Asian physical market prints a price wildly above the paper quote. Then the Western market resumes and pushes the price lower, restoring the appearance of control. If you were designing the perfect case study in the difference between managed paper and contested physical, it would look uncomfortably close to this. And the implications do not stop at one trading day. Because once a gap like that becomes visible, it plants a seed in every serious observer's mind. If the physical market can diverge this much from the paper market during stress, then which one should be used for planning? Which one should industrial buyers trust? Which one should investors study? Which one should sovereign entities accumulate through? That is how migration begins. Not all at once. Quietly at first. A refinery chooses more direct sourcing. A manufacturer increases physical inventory. A fund reduces reliance on futures. A central bank favors custody over claims. A wealthy buyer decides a bar in a vault beats an entry on a statement. None of those decisions individually breaks the system, but together, over time, they drain confidence from the paper multiplier. And once confidence drains, the paper market becomes increasingly dependent on one thing, that nobody tests it too hard. February 26 looked like a test. Not the final one, not the terminal one, but a revealing one. It showed how quickly the language of price discovery can become meaningless when the venue itself stops functioning. It showed that the East and West are not necessarily pricing the same silver anymore. And it showed that when the conflict between paper and physical becomes visible, the response is not clarification. The response is compression, distraction, and narrative management. Now ask yourself the question that matters most. If silver in Shanghai can trade near $104 while Western paper is roughly $15 lower, what happens if that gap widens instead of closes? What happens if more buyers decide they trust the market where metal moves, not the one where contracts multiply? What happens if a delivery culture starts replacing a leverage culture? That is when price stops being theoretical. That is when a metal re-rates not because an analyst upgrades it, not because a talking head notices it, but because the claims written against it lose authority. That is when silver stops being just another ticker and starts becoming what it has always threatened to become, a referendum on trust. And trust is the real story here. The exchange can recover from a technical failure. The market can recover from a volatile day. Even prices can recover from a shove lower. But trust, once cracked, behaves differently. When participants realize the benchmark can disappear at the precise moment it is needed most, trust weakens. When physical markets print a different reality than paper markets, trust weakens. When history shows that exchanges protect themselves before they protect the purity of price discovery, trust weakens. And once enough trust leaves the paper system, the revaluation can be violent. Because then the silver market is no longer just balancing mine output against jewelry, solar, electronics, and investment demand. It is balancing actual ounces against accumulated claims. And those are two very different equations. This is why February 26 matters far beyond one afternoon. It was a preview of what stress looks like when the paper system and the physical system stop speaking with one voice. It was a reminder that paper liquidity can vanish faster than physical demand. It was evidence that the most important number on the screen may not be the truest number in the world. And it was a warning that the next phase of this story may not begin with a headline screaming crisis. It may begin with more strange gaps, more inconvenient halts, more unexplained divergences, and more people quietly deciding they would rather own the metal than debate the contract. So here's the bottom line. On February 26, the silver market showed you two faces. One face was paper, frozen, delayed, then suddenly lower. The other face was physical, active, urgent, and dramatically more expensive. One face asked for trust, the other asked for payment. One was a promise, the other was a bar. And when a market reaches the point where the promise and the bar are speaking at different prices, you are no longer watching ordinary volatility. You are watching a system argue with reality. The halt is over. The trading session is gone. The official statements have already done their job. but the crack is still there, and the people who saw it are not going to forget it. So tell me this in the comments. When the next stress event hits, which number will you trust first, the paper quote or the physical premium? And if you have not subscribed yet, do it now, because this story is not getting smaller. The next chapter will not be about whether something is wrong. It will be about how long they can keep the two prices from colliding in public.